Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to do our daily technical analysis update of commodities. We'll take a look at the dollar, yields, precious metals, and the commodities and ETFs that I follow. If you guys have any interest in joining our community, you can definitely check out finding-value.com. Lots of really good information on the website. You can become a platinum member using the word discount in the coupon code and get yourself a little bit of a discount. So let's dive in. Let's take a look at what's going on, and I'll give you my financial opinions around it. So we've got the dollar here. It's the DXY, again, the relative strength indicator, and it is basically flat today. Nice little opening and closing price flat. So we still have this underlying strength in the dollar, though. So we've been moving on up, and we've got this little scare here. I think this trend is still intact for a move higher, as for however long that fear needs to dissipate in the markets. So I think that underlying trend is still there, and I didn't check into what Powell was saying. I'll have to look into it. I think he's going to remain pretty resilient with the increases. But looking at this, I think that trend's still intact, perhaps, and we just have a pause with news or an event in the market. I've talked about this before a long time ago. I invest for the structural underpinnings of the market, the things that have supply deficits, the market conditions where we're in an inflationary environment versus a disinflationary environment. And those are the trends that I look for. Now, looking at this, we've had an increasing interest rate environment, and that basically led to a strengthening dollar. DXY, relative strength. And the relative strength comes from the monetary strength from those increasing interest rate environment. And we increased it quite dramatically from 2021 onward, while others maybe not so much. This does, I think, depend on where interest rates are going. So we had a massive fallout of interest rates the past few days, and we saw the dollar drop. What that is basically telling us is that the dollar is linked to interest rates, and the relative strengthening or weakening of our interest rates impacts our value of our dollar. The demand it directly impacts the demand for the dollar. So when we look at this, keep in mind how interest rates are also moving in relationship to this DXY, because interest rates for this is the 10-year this is 10-year yields. So yields interest rates. You can see this gigantic move lower here these past 3 days there. That correlates with the decline in the dollar. And then we've had a bounce higher off that support level that we were talking about yesterday. I said, look for a bounce here, and we got a bounce of 3.5%. Now, when we look kind of a long, big picture view, I'm going to go logarithmic here. We've got this long-term decline of interest rates going like this, and we had a capitulation bottom. We've come up strong in those interest rates, and we could be kind of relaxing for a little bit on top of that support zone. The question I think a lot of people want to ask is this going to be sustainable, this move lower? Are we going to head lower, or are we going to use this as support and move and bounce on higher? Moving higher with interest rates tells us that there's an inflationary problem in the system. Moving lower, and this might be temporary based off of problems in the banking system. And we are going to collide those two things at some point, where interest rates could potentially go to a level where we run into problems in the banking system because we've been at low interest rates for such a long time. Are we going to break lower, or are we going to break higher here? And you know what? I don't know that path. All I can say is we've got a nice pattern here that's broken to the upside, and we have a return move. That generally means that we go higher. That's what I would say is the general pattern of what ends up actually happening. That's the statistical favor. The 30-year yield's doing the same thing. Yield basically broke out, and now we did a back test and we popped higher. Is this going to go higher? is the fear in the market going to reside, et cetera, et cetera. Generally speaking, when yields go higher, precious metals do not like that, generally speaking. And when interest rates go up, generally, I'm talking in general terms here, oil generally goes higher to some degree because interest rates chase inflation higher. And interest rates will go up if inflation is persistent. And inflation generally comes from oil, generally speaking. Bond prices go lower in an increasing interest rate environment. So we've been incredibly volatile with our bond prices here. You can see we had a massive move up and then a strong counter move to that move up. Our reversal day was yesterday. And we could see a lowering in bond prices. But the short term, it's going to be volatile. And that's why I don't play the short term. The short term is going to throw you all around. And then the TYX TNX ratio was basically flat today. It gapped down and then it was flat, sideways momentum, but it was down 0.9%. We had a massive fear move coming up where the curve normalized or uninverted, which is great for precious metals. The question we need to answer here is this move sustainable to the upside? Or are we going to get the curve to invert again because there's an inflation problem? And I don't have that answer for you. I wish I did. I wish I knew it. And I've got my, opinions and inclinations. Generally speaking, it's good to be accumulating precious metals down at a low level of the TYX TNX ratio because at some point the market will slow down, and that slowdown of inflation, the slowdown of the markets, the slowdown of all that stuff will be really good for precious metals. That is an ideal condition for precious metals. But we can still roll lower. Now, if we've got major problems in our energy delivery and on the supply side, we could really destroy I shouldn't say destroy, we could have a problem financially because it will drive interest rates higher, 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 and higher, and inflation higher. So we could be getting into that dynamic later on. But we might have weakness before that happens. I don't think it's weakness from supply. I think it's weakness from perhaps demand being destroyed. So there's no supply response, and I don't know if that supply response is going to come in quantities large enough in the future. And that's where you get the debate of what's going to happen next. Are we going to move higher in this? And are we going to move higher where gold and silver do incredibly well? Or are we going to move lower? And gold and silver can still do well. It'd just be a different regime. It'd be more like the 1970s. In the 1970s, you could see it declined back here, and gold did incredibly well under that. But that's because people feared the value of the dollar and feared that the dollar was going to basically go away. And that could happen again, where this declines and you get that fear in the market like that. It's not a fear of a bank contagion or anything like that. It's a different type of fear. The CRB index a little bit lower. Are we going to blow this thing to the downside? That is a possibility. We could have a move lower down here and a final washout in commodities before a wave 3 happens. I'm still bullish commodities from a big long-term perspective, but we could have a wave that comes back down here before heading higher. Generally speaking, we usually get about a 0.618 move, and this is not a 0.618 move from here to here. So a 0.618 would actually end up quite a bit lower in the short term if it were to hit that level. And what 0.618 looks like on here is we'll come up from the bottom there. I mean, that is down here at the 190 area. And we're at 261. So that would be a pretty big decline if that were to decline to that level. It doesn't have to decline to that level, but that is a general rule of thumb, about 0.618 or even 50%, which is probably in the 230s, 240s. That could be a scenario that we get down to. there could be a little bit more downside in a washout that happens. The CRB to S&P 500 still hanging in there all right. We've broken out of this downtrend or downtrend channel. Again, from a bigger picture view, we are in a long uptrend move for commodities to outperform the S&P 500. We've broken out. We've done our first wave. We get a pullback, and then the big third wave comes next. There'll be 3 waves in this third wave, and it'll come somewhere, maybe up to here or something like that. Maybe it comes there, wherever it is. But we're not done with wave 2 yet, or maybe we are getting close to being done of wave 2, because we do see kind of these lows stepping up, and we'll see if it holds. It may not hold. Remember those conditions I was talking about, the inversion of the yield curve. Gold slightly lower today, but that doesn't look bad here. It actually looks pretty bullish for gold. Nice big buying pressure with the small little bloody nose candlestick. You look at the weeklies, still looks real strong, and it could be a strong breakout. Now, why did I put it there? I was probably drawing it on a monthly perspective, and a lot of the times I put it on the closing price. I drew this line a long time ago, so what we can do is we can modify it. Let's do the weeklies here, and what I'll do is I'll modify this and put it up like this. So there we are, still chopping sideways in this big kind of big picture view. Look at it. Silver also falling a little bit today. You get that bloody nose. It's right above support. That support is the support underneath where we hit multiple times here, and we came up and hit it a couple times there. So we're basically moving around that support trend line. It still looks fine, still looks good for silver. It wasn't a big sell-off. Platinum, get a little bit more of a sell-off. This is the opening and closing price is capturing the closing price of yesterday. Generally, that is short-term weakness and a reversal candlestick. If you were to look at it from a trend line perspective, you can see that this is kind of the uptrend, and you can see that uptrend line, it's a steep one, is broken to the downside. There it is, broken to the downside over here. So generally it could be a reversal candlestick where we had a little bit lower in the short term. Looking at the XAU to gold ratio, it still looks very favorable for gold and silver mining companies, at least today. And I'd like to see this come up and break that big long-term happiness line that I always talk about. The happiness line is when gold and silver mining companies outperform gold, and gold is moving up. And that's probably a high possibility or high probability as we've got a low, a higher low, and a higher low, if this holds, walking into that downtrend resistance line. GDX still performing good, 0.8% higher. Let's see what this looks like on the dailies. Still working out pretty good. We've got this big gap here. It might come back and close that gap at some point and move on up. I know a lot of people get worried about gaps. I'm not as worried, but looks like this gap was closed down here. Get a gap. This has got gaps everywhere. Gapalicious. But nice move on up there. We've got SILJ moving up 1.3% with a little gap down here. But that still looks good for this trend line that held and popped higher. We've got crude oil getting hit today, down 4.4%. We do have a little wick at the bottom. Not that I'm putting any sort of thing on it, but we could come back down to a lower oil price if this fear persists. That is a possibility. And we've got a major trend line coming out all the way down to like $50. Will that get hit? I don't know, but if it does, that's going to provide one heck of a buying opportunity. We are right now at this other trend line. If you draw the trend line at the bottom here through here, we're right on that trend line right now, and we're resting on it, that support line. So we want to see if this thing breaks to the downside or if we're going to head higher. Could we have a washout where it washes people out and we head lower? Yeah, we could, and that's what happened last bull market. So we'll take a quick look real quick just to show you what that washout looks like before the bull market here. So what happened was this thing basically, it basically was on this trend line here, and we broke out to the downside and washed out, and then we went higher after that. That occurred in September, October, November, and we bottomed in January of 02. We started heading higher in January of 02. Crude oil is very inflation sensitive, and the fear in the market, the deflation versus inflation, all of that has an impact on the pricing of crude oil. But right now, we are seeing a lot of selling pressure. We could see lower prices in crude oil. Natural gas still looking pretty good, actually. Nice big move on up, a small pullback, and you can see the intensity of the down days is starting to calm down. We do have a bloody nose today, which is generally a continuation pattern to the upside, but it's looking better. We're getting the green candles, big green candles, to come in and get some buyers down here. XOP, yeah, you know me, moving sideways, 0.64%. We still have a lot of momentum coming on down. We still have crude oil that is selling off. One thing that's positive is XOP is up today, even though crude oil is down quite a bit. So that is a positive for the sector. But again, if crude oil continues to head lower, it's going to weigh on XOP and even OIH. OIH went sideways today, 0.7%. It's trying to slow this move down. We've got lots of momentum to the downside. It's got to get slowed down first. We've got Sprott Physical Uranium Trust moving down lower today. It does look like that will continue lower until I see a reversal candlestick. We've got URNM also right at that support level that I was talking about. We don't want to break below $30, and I don't want to see a big old down day. And it's possible that we get a big down day and we head lower. It seems like the market sentiment's pretty negative out there, but it doesn't mean it can't get more negative, and there's a lot of fear in the market. That fear drives opportunities. Opportunities for those who do not succumb to the emotional fear. TAN is looking a little bit stronger, up 0.65%, right in the corner of this squeezing pattern. We've got COPX. COPX is the copper ETF. And again, we're up a little bit, but the momentum is still heading lower. Got to see more buying pressure. Lithium just moving sideways today. And again, looking at it from a longer term perspective, we have buying and selling pressure right there. It is a battle. REMX, rare earth metals, this has got some selling pressure behind it on a monthly candlestick, basically moving sideways today. And there has been support at these levels before. We've got SPX slightly higher today, but again, we've got lots of selling pressure in here. There's still fear in the market. There could be another down move after this. Why do I say that? A lot of the times I see large selling pressure like this, those big candlesticks down, and then the move isn't as strong to the upside. So we're just measuring the selling pressure versus the buying pressure. A lot of times this rolls over and we could head lower in the short term. NASDAQ's got a similar setup. Now, that doesn't mean it has to happen. I don't play the short term because the statistical probabilities are a lot lower. You're looking at 60%, 70% at best. But we're right at this resistance support level, and we'll see where this thing breaks. Emerging markets, nice little small down day today. It's right at support. We'll see if this pulls on back or not. We've broken this longer term downtrend line here. XHB, the home builders, that's hanging in there right at support. We've broken this downtrend line, put in like a double bottom, broken that, and doing a retest move. MOO also coming on up. Now, this is going to be a fight and a struggle because we've got large selling pressure in these candlesticks there. You can see that selling pressure. The buying pressure is probably going to come up to here and then roll over and head lower. That is my opinions there. Copper, we've got a little bit of selling pressure today, but we're just basically moving sideways. I'm looking at these candlesticks. They're pretty equally balanced here, and we're above a longer-term support level. That white line going across here. Lumber, up 0.75%. The housing market is still holding up quite well. And I think that's where Powell needs to continue to increase interest rates or hold them up at a high level to hold this down. This is where inflation comes from. It's not lumber itself, but it comes from the home builders and the expansion of credit in the system. Iron ore continues to move on up. That looks quite strong with China reopening. So actually, that looks very good. And you can see that we're getting a pretty good drive out of this. This was our reversal candlestick in the China reopening. It was moving up before that. Nickel heading a little bit lower on the longer term. This could be a Batman pattern where we head lower in the short term. This highly depends on the fear in the market, if we're going to have a recession, and what people are thinking. Aluminum is going to be the same way. It's a little bit more sensitive to those types of thoughts, but nonetheless, it was up today, 1.3%, and it does look like we could firm up here and move on higher for aluminum. Baltic Dry Index continues to move on up. This thing looks fantastic for a continued move higher. Keep in mind, though, we could get a pullback before heading higher. We call it a retest or a back test. That is a possibility. Newcastle coal heading on down right here, right at support. We've got Ethereum up 1.89%, putting on a big candlestick up here, which means it could reverse. That's generally a reversal candlestick. And then we also have Bitcoin that was up a lot. And we have that big wick. That's generally a reversal candlestick to move lower, because that is a lot of selling pressure. If we were to look at it from a short-term perspective, you can see that reversal selling off there towards the end of the day. So that's what we've got for today, guys. I know I kind of went through it a little bit lengthier today. I still think I'm still in the camp of a long-term commodity bull market, super cycle, all that stuff. I know a lot of people, they look at the short-term price movements, they say, oh, super cycle is not going to happen. It's not this. Guys, things move in waves. They move in waves. Wave 1, wave 2, and we're going down in wave 2, and then we've got a big wave coming of wave 3. Wave 2 could pull back even further than where it has today. Why am I not selling? Why am I not trying to time all this stuff in the short term? The short term isn't as reliable as the long term, period. So what I've learned over these years is, rather than trying to play the short term in out, guessing where it's going to go, because anything can move the markets, it can also impact myself emotionally. I'm about as logical as I can get, but sometimes you're like, oh, should I sell here? And then you've got all these decisions. You're basically deciding if you should buy or sell every single day there is. If you take a big, long picture view of it, you just take all that off the table. You're like, nope, big picture view. All I'm going to worry about is, where am I going to accumulate? And all I do is accumulate on support levels of what I think are the best companies. So then, rather than using price as your ultimate indicator of something being right or wrong in the short term, I'm using big picture views, big patterns, to determine if I'm right or wrong. Then I look at the structural underlying fundamental conditions of the market. Are we in deficit or are we in surplus? And is credit going to expand or contract? And that's really all I look at. So if expanding credit, right now we are in a tightening phase. That's why we continue to increase those interest rates up. I think it's something on the lines of an early 2000, like 2000, 2001, 2002, that type of time frame. And the reason I think that is because we still have an undersupplied market in the real estate market. That's the thesis of the channel. It's the business cycle. And if you have an undersupply, then that is still true. It means that there's going to be homes that will be built and credit will be expanded. All of these cycles, they've ended with an oversupply of homes. There's been an oversupply of homes in some of these timeframes as well, like the 70s, and it came back, but the demographic came back too. We have a steady demographic here that are coming into home buying years. And the thesis, the credit expansion, those homes have not been built yet. And we can see data For instance, the most amount of traffic of all time has been searching to build new homes. That means something. It means that the demographics there, but affordability is a problem at this time. And we've seen a little bit of a pullback on home prices. And that may persist as long as interest rates remain high. And I'm going to go back to the question of what is Powell going to do as a second act? So let's say he holds these rates up here, and he holds them and holds them and holds them. What's he going to do? We're going to have interest payments skyrocket, like big time skyrocket. So there's going to be a problem, and inflation can come from deficit spending, which spirals out of control because the market's going to want to raise rates when inflation comes. And the thing that's really going to hurt them is deficit spending with increased interest rates of the interest payments. So increasing interest rates and the interest payments is going to run a large deficit, which is inflationary. And then that's going to drive higher interest rates, which gets you into this loop, this debt loop, called a debt spiral. And if you have a problem in your energy supply, that is what increases your GDP, which means if your GDP can't grow effortlessly, if we can't really ramp GDP up, when they ramp that money up, whether they like it or not, then you've got a problem. And if they lower interest rates back down because they want to afford the debt, well, now you can't control inflation. So they're going to get inflation if they keep interest rates high, and they're going to get inflation if they try to draw the interest rates back down because of the demographic in home buying years and because of the debt in the system. We cannot have a prolonged deflationary move. The reason is because states, governments cannot sustain lower tax revenues. They need things to go up in price so they can tax it. They need increasing tax revenues to service debts and obligations like pensions, Medicare, Medicaid, etc., etc. They need inflation, but they want it to be controlled at some rate. And that's really what the background is. And the most inflation-sensitive assets is oil and natural gas. It's energy. And what protects your purchasing power against that type of scenario that I just described is precious metals, physical precious metals. So that's what I look at, and that's what I try to invest in and take a big long-term, big picture view. And if that interests you, definitely join our community, guys. Sign up to the website, jump on our question and answer, platinum question and answer session calls, ask away, ask questions. I'm going to be doing a training coming up here. I'm going to schedule it shortly. And it's just little kind of tricks that I look for when I invest. Just little tricks and stuff. I've done a lot of technical analysis stuff. I've done, obviously we do a lot of platinum question and answer videos. They're all on the website for everyone to view. And you can see my portfolio and all that stuff as well. But that's what I've got for today. Kind of talky, I guess, today. But we'll catch you next time. This is Finding Value.